Listen carefully. I want you to understand something right from the beginning that most people are not willing to accept. We are not watching a normal market cycle unfold in silver. We are watching the early stages of a structural adjustment that most investors will only recognize after it has already moved too far to ignore. And by that time, the opportunity will no longer look like an opportunity. It will look obvious in hindsight. Right now, the majority of investors are still trapped in a familiar mindset. They are treating macro conditions like a short-term debate. They are focused on central bank timing, inflation prints, and whether risk assets will continue to drift higher in the next quarter. But that entire framework assumes stability in the monetary system. And I am telling you directly, that assumption is becoming less reliable with every passing cycle. This is not about a minor fluctuation in silver prices. This is not about a temporary spike driven by sentiment or speculation. I am talking about something deeper. A repricing process that begins when long-standing financial assumptions stop holding their weight under real economic pressure. You need to understand what happens before a major transition in any monetary system. It does not begin with headlines. It does not begin with consensus. It begins quietly in the structure of behavior. Assets stop reacting the way they used to. Correlations begin to shift. Old resistance levels lose meaning. And most importantly, investor conviction begins to fracture in slow, almost invisible stages. That is the phase I believe we are entering in silver right now. Ray Dalio has spent decades explaining how long-term debt cycles evolve. And one of the most important insights from that framework is simple, but extremely uncomfortable. When debt levels reach extreme territory, the system loses flexibility. Central banks are no longer operating in a neutral environment. They are constantly forced to choose between financial stability and currency stability, and there is no option that is truly painless. If they tighten too much, the system begins to break in credit-sensitive areas. If they ease too much, the currency begins to erode in purchasing power. Over time, this creates a structural bias toward accommodation. And accommodation, by definition, changes how real assets are priced. Now think about silver in that context. For years, silver has frustrated investors. It has moved in cycles that felt incomplete. It has broken out and failed. It has advanced and retraced. And because of that history, most participants now approach it with skepticism rather than conviction. But that psychological conditioning is exactly what sets the stage for a larger move. Markets do not reward confidence at the beginning of a transition. They punish it. And they reward patience that survives long periods of uncertainty. What you are seeing now in silver is not random. It is behavior that suggests accumulation beneath the surface. Price advances are met with controlled pullbacks. Weakness does not fully collapse structure. Instead, higher support levels are forming quietly. That is not what a purely speculative market looks like. That is what a transitioning market looks like. And here is where most people get it wrong. They assume that because nothing dramatic is happening on the surface, nothing important is happening at all. But in macro terms, the most important changes almost always begin invisibly. They start in liquidity conditions and balance sheet constraints and funding structures that most retail investors never see. This is also where the debt structure becomes critical. We are in a global environment where total debt has reached levels that fundamentally alter policy behavior. In that environment, real interest rates cannot remain deeply positive for extended periods without creating instability somewhere else in the system. And when real rates fail to act as a stable anchor, cash stops behaving like a neutral asset. It becomes a slow erosion mechanism for purchasing power. At first, people do not notice it, then they rationalize it, and eventually they are forced to respond to it. That response is where capital rotation begins. Gold usually reacts first in these phases because it is the most established monetary hedge, but silver tends to follow with more volatility and more force, especially when industrial demand is present at the same time as monetary pressure. And that combination is becoming increasingly relevant. You are not looking at silver in isolation anymore. You are looking at silver inside a system where debt pressure, policy limitation, and real economy demand are all interacting at once. And when those forces align, markets do not move in a smooth way. They move in compression first, then expansion. They move in periods of frustration, followed by rapid repricing once positioning shifts. Most investors are still waiting for confirmation from the old regime. They want clean signals that fit previous cycles. But the problem is the previous cycle logic may no longer apply in the same way. That is the real risk here, not volatility, not correction, but structural misunderstanding of the environment itself. And if that misunderstanding persists, the repricing will not feel gradual when it arrives. It will feel sudden to those who are not paying attention to the structure forming underneath the surface. What most investors fail to appreciate is that silver is not just reacting to market sentiment. It is reacting to a deeper coordination of forces that operate over long time horizons, far beyond quarterly economic data or short-term policy decisions. And once you understand that, the price action stops looking random. It starts looking like pressure building inside a system that is gradually losing flexibility. Let me be direct with you. When debt expands faster than productive output for long enough, the entire financial structure begins to depend on continuous accommodation. That accommodation can take many forms: lower real rates, balance sheet expansion, liquidity injections, or subtle shifts in regulatory tolerance. But regardless of the form, the outcome is the same. Currency confidence becomes more sensitive and real assets begin to reprice relative to that weakening anchor. This is not theory. This is the observable pattern of long-term debt cycles. And Ray Dalio's framework is useful precisely because it removes emotional interpretation and focuses on mechanical cause and effect. When obligations accumulate to extreme levels, policymakers lose the ability to normalize conditions without creating instability somewhere else, so they adjust, and markets adjust with them. Now consider what that means for silver specifically. Silver sits at a unique intersection that most assets do not occupy. It is both a monetary asset and an industrial input. That dual identity is critical because in periods of monetary stress, investors seek stores of value. But in periods of technological expansion, industry consumes supply in a structural way that does not respond quickly to price changes. When those two forces converge, you get a market that is far more sensitive to imbalance than most people realize. And right now, imbalance is exactly what is building. On the supply side, silver production is not easily scalable in response to price signals. A significant portion of global silver output is tied to base metal mining. That means supply decisions are driven by copper, zinc, and lead economics, not silver demand alone. So even if silver demand increases meaningfully, supply does not immediately adjust in a proportional way. That creates rigidity. And rigidity matters because it removes the system's ability to self-correct smoothly. In flexible markets, price rises trigger supply responses that stabilize the system. In rigid markets, price must do more of the adjustment work itself. Now add the demand side. Industrial consumption of silver is not speculative. It is structural. It is embedded in electronics, energy systems, medical technologies, and the broader electrification of the global economy. These are not optional uses that disappear when price rises modestly. They are necessary inputs, so you have a situation where a large portion of demand is inelastic and a large portion of supply is constrained. That combination creates conditions where pricing becomes the only variable capable of restoring balance. But here is the part most investors underestimate. This process does not require a crisis to accelerate. It only requires persistence. If deficits continue over multiple periods, inventories begin to tighten. And once inventories tighten, market behavior changes before official data fully reflects it. You begin to see subtle shifts first. Premiums adjust. Delivery timing changes. Institutional positioning becomes more defensive. And then gradually, price begins to respond more aggressively to relatively small changes in demand. This is how repricing starts. Not with panic, with friction at the same time. Monetary conditions are influencing capital allocation decisions in the background. When real yields remain uncertain or structurally constrained, capital does not sit idle. It searches for alternative stores of value. That is where precious metals enter the equation. Gold often acts as the initial signal, but silver tends to amplify the move once participation broadens, because silver markets are smaller, less liquid, and more sensitive to incremental flows. The same level of capital rotation can produce disproportionately larger price responses. This is where the psychological dimension becomes important. Most investors are still anchored to previous experiences with silver. They remember long consolidation periods. They remember failed breakouts. They remember volatility that punished conviction. And because of that memory, they tend to dismiss early structural signals as noise. But that dismissal is not neutral. It is part of the cycle because early disbelief is exactly what allows accumulation to occur without excessive attention. Stronger hands position gradually during periods of frustration. Weaker hands exit during periods of uncertainty. And by the time consensus shifts, the structure has already changed. This is why Dalio's concept of long-term cycles is so important. It teaches that systems do not change because sentiment suddenly flips. They change because underlying pressures build until the previous equilibrium can no longer hold. And when that point is reached, adjustment is not optional, it is mechanical. Now, I want you to connect this back to silver's current behavior. You are seeing periods of controlled volatility. You are seeing higher lows forming over time. You are seeing responses to weakness that do not fully break structure. These are not signs of randomness. These are signs of a market preparing for a different regime. And in that context, the question is not whether silver will move. The question is what type of environment is forming that will determine how far and how fast it moves once broader recognition begins, because once recognition arrives, it rarely arrives alone. It comes with capital flows, with model adjustments, with institutional reallocation, and with narrative reinforcement. And by then, the early stage opportunity is already behind the majority of participants. We are not at that stage yet. But the conditions that lead into it are becoming harder to ignore. At this stage, you need to zoom out even further because the real story is not silver in isolation. The real story is the structure of the global monetary system itself and how assets are forced to reprice when that structure loses stability over time. Let me be very clear. Markets do not move in isolation from policy. They respond to policy constraints, liquidity conditions, and debt dynamics. And when those three forces begin to tighten at the same time, the system does not remain neutral. It begins to select winners based on scarcity, trust, and functional necessity. That is where silver begins to shift from a peripheral asset into something far more central. We are living through a period where debt burdens across major economies are no longer marginal. They are structural. And once debt becomes structural at a high level, policy stops being purely reactive and becomes increasingly constrained. Central banks are no longer simply managing inflation or growth. They are managing system stability, and that changes everything because in that environment, interest rates cannot remain elevated indefinitely without consequences. Yet lowering rates too aggressively also carries risks. This creates a narrowing corridor of policy flexibility. And when flexibility narrows, the market begins to anticipate outcomes rather than react to them. This is where real assets begin to reprice ahead of visible confirmation. Silver, in this context, becomes more than just a commodity. It becomes a proxy for two things at once. First, confidence in monetary stability. Second, demand from industrial systems that are expanding regardless of monetary conditions. That dual exposure is what makes silver particularly sensitive during transition phases. Now consider what is happening underneath the surface. Industrial demand is not slowing in a structural sense. Electrification continues. Energy infrastructure continues to expand. Semiconductor complexity continues to rise. Data systems continue to scale. And all of these trends rely on silver's physical properties in ways that cannot easily be substituted. At the same time, supply does not respond quickly. It is constrained by mining structure, by byproduct dependency, and by long development timelines. That means even when demand changes meaningfully, supply cannot immediately adjust in a stabilizing way. So the burden of adjustment falls on price. And price adjustment in constrained systems does not happen smoothly. It happens in phases. It compresses. It builds tension. It breaks through resistance. It consolidates again. And then it accelerates when participation expands. This is the rhythm of structural repricing. Most investors misinterpret this process because they are conditioned to expect linear movement. They want clarity before commitment. But markets rarely provide clarity in advance of major shifts. They provide ambiguity. And that ambiguity is what creates transfer of positioning from impatient participants to strategic participants. That is exactly what long-term cycles are designed to explain. Not prediction, but behavior under stress. Now, I want you to think about capital itself. Capital does not move randomly. It responds to incentives. When real returns in traditional instruments become uncertain or insufficient, capital begins to rotate toward alternatives that preserve value under different conditions. That rotation does not need to be large at first. Even small shifts in allocation can have significant effects in a smaller, more sensitive market like silver. And once price begins to respond, it reinforces the original signal, attracting additional flows. This is the feedback mechanism that defines early-stage regime shifts. It does not begin with mass awareness. It begins with small but persistent changes in behavior that compound over time. And here is the critical point. We are still in that early phase where skepticism dominates. Most market participants are not positioned for a structural repricing scenario. They are positioned for continuation of previous cycles. That mismatch is where asymmetry exists. History consistently shows that major repricing events are not recognized at the beginning. They are recognized after multiple confirmations have already occurred. By then, the easiest portion of the move has often already unfolded. This is why understanding structure matters more than reacting to headlines, because headlines will always lag structure. Now I want to bring this back to Dalio's framework one final time. The key insight from long-term debt cycle theory is that systems move through phases of expansion, saturation, and adjustment. We are not in the early expansion phase anymore. We are dealing with accumulated debt pressure and diminishing policy flexibility. In that environment, financial repression becomes more likely over time, and financial repression changes how investors think about holding cash versus holding tangible assets. Silver sits directly inside that transition, not because it is speculative, not because it is trending, but because it exists at the intersection of monetary uncertainty and industrial necessity. And intersections like that do not remain stable forever. They resolve through repricing. And once repricing begins in a system like this, it does not simply reverse when conditions normalize slightly. It tends to persist until a new equilibrium is established. That is the part most investors underestimate. They assume reversibility, but structural shifts are not easily reversed. They are absorbed, adjusted to, and then reflected in a new baseline. So the real question is not whether silver will experience volatility. The real question is whether you recognize the stage of the cycle before the majority does. Because once recognition becomes widespread, the structural advantage is already reduced. And by that point, the market is no longer pricing in change, it is pricing in confirmation.